What is a watch list? Let's start with you, John, and then we'll go around the table.
It's the list that you use to watch for the stocks that you think are going to go in the direction you, well, let's say you want them to go into. So you put them into a watch list so you can,
Okay, that's fine.
instead of looking at all the stocks, you can just look at those stocks. Yeah,
Right.
yeah.
Neville?
Okay, I'm going to try. Can you hear me?
100%,
I'm going to
yes.
say a watch list is a collection of stocks or instruments or whatever that you're looking at that meet your trading strategy or are pretty close to it. So you don't have to sit and view 1,000 stocks. You can maybe have 3 or 4 on your watch list.
Okay, good. Sam?
Yeah, I think John and Neville summarized it. I think portfolio management strategy where you identify certain stocks or certain instruments, investment instruments, and then at a certain stage buy or dump them.
Great. A watch list is a carefully selected number of markets that you'll use to analyze, monitor, and focus on when you trade. So notice I used the word markets instead of stocks or currencies because markets relate to any financial instrument. So why this is an important topic for today is to put it into perspective. There are over 300 stocks to trade in South Africa. There's over 8,000 companies in the US alone and over 43 stocks to choose from worldwide. And that is just with stocks. There are also countless number of currencies, commodities, indices, ETFs, cryptocurrencies, and so on. So as traders, it is our duty to turn that mass data into a manageable list. Okay? And to do this, you filter them by choosing a certain criteria on how to go about putting in the markets that you want into your watch list. How do you choose markets in your watch list? So once again, we're talking about the criteria that you use to find markets to place in your watch list.
I would presume that it depends on whether you want to short or buy long. So you would look at markets. So let's assume you want to buy long. You would go and look at a bull market, identify those stocks or commodities or investments instruments that are performing well, and then look at your charts depending on what tools you use in the charts, and then you would select those.
Okay,
And
brilliant.
alternatively, if it's a bear market you want to do, if it's a bear market you want to get into and you want to sell short and you want to take a bit of an extra risk, that's how you would do it.
Absolutely. I like the first two things that you said the most, and that is you look for good markets and also you look at the charts. And if I had to sum up my criteria on finding markets to place into my watch list, basically I can sum it up into 3 words: blue, healthy, and unhealthy. Okay? So what I mean by blue is that, for example, you get blue chip stocks. And blue chip stocks in South Africa are stocks that have a market cap of over 20 billion, and they are considered the blue chip stocks. So they're the most popular, the most established, heavily invested stocks on the JSE, according to what's called market capitalization, which is the number of shares times by the share price. So once you have that, then you know that you have got high liquidity, high volume stocks. Okay, so with the JSE, or in South Africa, I look at the top 40 stocks listed on the JSE. I then look at the top 18 stocks listed on the S&P 500. I look at the top 11 stocks on the Dow Jones, 28 stocks on the FTSE, and 9 major forex currency pairs. And that is based on a criteria that matches my multi-trader system, and that works in general. And I'm always adding onto the watch list. I'm always taking off the watch list depending on the criteria. So the question that everyone answered, and Neville, I think you missed, is that how do you choose markets to add into your list? So the first thing I said is that it depends on the market capitalization. So I'm always looking at the biggest stocks, the major currencies, the largest indices, the blue chip stocks on the JSE, which has a market cap of over 20 billion. And by knowing that I have the highest market capitalization markets, I know that there will be enough liquidity, there'll be enough volume, and there'll be enough trending moves in the markets that work perfectly with my strategy. So that's just criteria one. Then I have another criteria, and that is when it comes to stocks, because the main thing that I trade are actually shares, due to a number of reasons that I won't get into today. But the second criteria is that I look at where stocks trade over 500,000 trades per day, or 500,000 shares traded per day. By this, I know that the market is not going to jump or be too volatile and gap too high or too low, and I won't have to worry about too many jumps between the buy and sell or bid and buy price. So liquidity is very important when it comes to choosing your watch list. And the third criteria is what I call healthy and unhealthy stocks. John, what would you consider a healthy chart?
One that's trending up or trending down is a healthy chart.
Good. And
the ones that are sort of stuck in a range is more, sort of more unhealthy in a way.
Good. What about an unhealthy chart?
One that's very volatile.
Good. Yes. Volatile.
It's going up and down, yeah.
All right. Neville, you want to add on?
Yeah, I would say that healthy chart is one where you've got like sort of a logical type of movement. In other words, there's no huge movements up or down, whereas an unhealthy chart, there'd be huge gaps and large spikes where people are selling off, and then the next minute people are buying, and you have no clue which way this chart is going.
Very nice. Neville, can I just ask you, are you an owner of the multi-trader system program?
Yes, I am.
Okay, because I could hear those words coming out of my mouth. I do like the way you summed that up, Neville. I don't have much to add to that. All right, so we can see in the charts the difference between a healthy and unhealthy. So the first important thing is that there's average size candles in a healthy chart. The second thing is that there's low volatility, less jumpiness. The trends are clearly moving up, down, and sideways. Notice that I also look for healthy charts that move sideways. But the most important thing is that there's little to no gaps. By little to no gaps means that the differences in price moves between the bids and offers, or the buys and sells, are very close to each other, so we don't get that jumpiness like you get with penny stocks or pink sheets. The unhealthy chart, as you can see, there are huge or tiny candles, and I do not like big candles because it will stop you out if you get into your trade. There is high volatility, so erratic moves. There's no trend, and there are many gaps inside.
Timon, I think you've summarized it very nicely. One thing for me is always confusing, is that can you have a healthy chart but very small volume? Is that possible?
It's absolutely possible. If you go look at any recent stocks that have been listed on the JSE or in general, what happens is you will see little to no volume trading because the conservative investors do not pile in at this time. So you will see stocks jumping up and down, and this normally happens with IPOs or initial public offerings from stocks that have just entered into the stock markets and stock exchanges, and you will see that kind of low high volatility, low liquidity, and then after a couple of months it starts to even out. Investors start to get an idea of the valuation and for example, the earnings per share, and then they drive up the market. Well, smart money then comes into the market on a more consistent basis and drives up the trends on an average daily basis. So, for example, when Facebook listed, I think it was $30. I might be probably horribly wrong, but when Facebook listed at $30. It would then jump to $20, then it would go up to $40, and it would create that high volatility that we don't want as traders, and that alone is considered an unhealthy chart, despite the fact that it is a good company. We have the final question. What markets won't you trade and why?
I've never thought about this one. So I'll pass on this.
Okay, Neville.
Penny stocks, because I don't understand them, and once again they're way too volatile. Nor do I think my broker actually allows me to trade them. So
Forex, when it comes to Forex, I will not trade any minor currencies. So minor currencies are anything other than the major currencies. There is no right and wrong, and I do not have all the answers for every trader. Some traders thrive off volatility. Some traders trade on non-farm payroll days. Other traders trade on indices that are more foreign than ours. So, for example, the Hong Kong index, I do not trade because it does not fit my strategy. The Spanish index, it fits my strategy perfectly. It is absolutely gorgeous, and I would definitely trade it. But it also, I cannot trade it because there are no available brokers. And also, the brokers that do have it available, not many people are trading the Spanish index, the IBEX index, which is the Spanish index. And because, once again, it's down to liquidity. So even if the brokers offer the IBEX, the question is how many people are actually trading it. So on a general basis, the index is perfect. On a broker basis, it is too volatile. So I'm unable to do that. The currencies that I will never trade, believe it or not, is the minor currencies. So the minor currencies are anything other than the big nine. The minor ones are other currencies, so the hundreds of currencies. And the South African Rand doesn't even make it into minor currencies. It is actually an exotic currency. So I won't trade it, but I will invest it so we can see the general trends on where it's going. Okay? Other Forex that you won't trade are ones that have high gearing. So I will refuse to trade markets that have a high gearing where you can lose a lot more than what you put in depending on the margin that you see. And the third thing is that you always got to look at the options available to the broker that the broker offers you, and then see if it matches the criteria on whether it fits your strategy to a T. Now I want to open to the public, and I want you to ask questions based on today's session.
how many items should you have on your final watch list, if you want to call it that? Or is there a differentiation between an initial watch list or your database that you're starting from to the one that you're finally going to work from?
It's a good question, because when I started off trading, I would go and pick off other successful traders' watch lists that they trade, and then I would adopt it as my own. So I had a group of members that only traded the All Share 40 index and nothing else. And every day I would watch this index and I would follow the system, but it didn't suit my personality. So then I said, okay, I need more action. I'm a young guy and I would like some action in my trading, where I can take a number of stocks. So then I looked at the JSE top 40 stocks. So I've got 40 stocks on this list. And then I said, but now what happens if the JSE or South Africa crashes for long periods of time, or moves in a sideways range? For example, after the financial crisis in 2008, we then had a lack of activity throughout most of the main sectors on a sideways basis, which did not bring any revenue to my multi-trader system. Okay, and then I had to look at other indices, and I had to look at other stocks internationally, and then the forex currencies. So today, I think, as I said, if I have 20 stocks on the JSE, I've got 20 stocks on the S&P, I've got 11 stocks on the Dow Jones, and I've got 28 something stocks on the FTSE and 9 major currency pairs. So 40, 60, 70, 80, 90. I've got about 100 items on my market watch list that I look at on a weekly basis. It doesn't take me longer than 10 minutes to analyze every single market on my watch list, because I literally just press the down arrow and I look, and the first question I say is there a pattern? If there's a pattern, then I take the trade. If there and it's broken out, I take the trade. If it hasn't broken out, I then write it down that it could possibly break out. And how many trades do I take a week? 1 or 2. And that's looking at 100 markets on my watch list and trading 1 or 2 trades per week.
Sometimes you can have 2 markets that you're watching and they're running in totally opposite directions. So I'll give you an example. Is sometimes when there's a bear market and the stocks are plummeting, commodities are racing up. For example, gold, because it's a safe haven. So is it worthwhile looking at markets which sometimes may run in parallel, but on some occasions under certain economic circumstances go in directly opposite directions?
Can I just change that example to gold is going up and Anglo gold is going down? Is that what you're asking?
Yes. Okay.
Yes. Well, remember, as traders, we don't care which direction the market goes, as long as it does go in a certain trend. So if gold is going up, there are international reasons why gold is going up. If Anglo gold is going down in South Africa, there are reasons that have nothing to do with the commodity of gold. So we shouldn't ask too many questions, because then it leads to speculation saying that if gold is going up, therefore Anglo gold should be going up. No, gold is going up because it's becoming a rarer commodity. The mines are, the veins are becoming deeper and deeper. The cost of mining is becoming more expensive, and the rarity is increasing. So the supply is becoming less, so the price is going up. But if you look into South Africa and you say, what is going on with Anglo gold then? Well, Anglo gold might have nothing to do with the bigger gold companies in the world that are performing. For example, all gold mines are closing in South Africa. The costs of mining gold is a lot more expensive, which is detrimental to the companies as they have to close down their mines, despite the fact that gold is going up. But now that is a fundamental analysis on that, which can drive somebody crazy, because now we could have a debate about everything that I just said, which would then break the contrast. And remember, as traders, we don't have an ego. If the market's going down, there is a reason. If the market's going up, there's a reason. And if gold is going up and Anglo gold is going down, well, this is a fantastic opportunity to hedge the market. If you think about it, as traders, we want to also protect positions. So what better way is it to go long gold and short Anglo gold, and the one that we lose, we will take the loss, and the one that we win will make 2 times more based on the risk to reward. So we do look at these type of markets and these contrasting markets that are moving in opposite directions because they provide new and broader opportunities for traders. All right. I don't know if that brings a different way of thinking about hedging as a trader, which we might even have to do an entire topic around it.
Yeah, it's a good idea.
I second that.